Welcome to Mortgage Therapy with Chris Sorensen. I have a special guest today. I'm very excited to talk to you, Justin. So, Justin Margolis, he is a phenomenal, I call him a young Jedi, but he's wickedly smart when it comes to the mortgage business. And he comes from great pedigree. One of our original OG branch managers, his dad, Fred, raised him as a pup into this business. And you've overtaken, right? I mean, Justin, listen, I've got plenty to ask you, but what's it been like from the beginning working with your dad, somebody who everybody has known and respected in the industry forever, and following in his footsteps?
That's a great question. As soon as I've been born, I've always lived and breathed the mortgage business. I mean, I remember being 10 years old, my father on the phone or telling us to stop talking in the car. He needs to take a client call. I've been there. Um, it's great because it's kind of like having my own coach, but at the same time, it's always business when it comes to the mortgage business with us. Um, and it's really allowed me, I think, to excel because I always told myself, my father's always been a top producer, but I got to be better. And I think that's one of the reasons why I've fueled myself to get to this level.
It's interesting because a lot of folks that, in your position would see how hard your dad's working and those, like you just said, those calls where he's got to pull over on the car or he's got to step aside and say, hey, everybody quiet down for a second while I take this call. And it could turn you off to the business. Why do you suppose it did not turn you off the business? Why do you suppose you gravitated towards it?
Great question. Funny enough, when I was a kid, he always said to me, "You're never going to join the mortgage business. It'd be the worst thing that he would ever do." But honestly, I just gravitated to it. In sales, your income earning potential is at the highest it can be compared to doctors and lawyers and many other careers out there. Prior to going into originations, I went into the real estate servicing and mortgage servicing business. So I handled commercial and residential servicing and foreclosures and REO property. So I kind of went into a different aspect of that, and the rest is history.
Yeah. You know, you mentioned doctors. I always say doctors, lawyers, and Indian chiefs, and it's so true that with well, literally with no formal education, with no student loan debt, one can jump into this business, and if you're disciplined as you've been, you can excel and make more than a doctor, lawyer, or Indian chief. Um, I want to talk a little bit about specializing because while a general practitioner, the saying goes, a general practitioner can make a very good living. A specialist will oftentimes make a better living. And you can do all loans, but I know you personally with my experience. And by the way, not that it matters. I think the Billy who kind of organizes these podcasts will let people know. Just so people know, Chris Sorensen, Mortgage Therapy, Senior VP, Director of Retail Production for PRMG. I kind of was very short on my intro because I wanted to get right to the point. And Fred Margolis is one of our phenomenal top of the food chain, perennial president's cabinet member, um, branch managers. And so you decided to kind of focus. First, I noticed you focusing a lot on jumbo, and you still do plenty of jumbo loans, that's for sure, multi-million-dollar loans. But it seems like in the last 2 or 3 years, you really gravitated and took hold of the non-QM space. Talk to me about that.
Yeah. So during the COVID days, I originated, let's say, $100 million a year in all types of business, refinances, Fannie Mae, FHA, VA. And when PRMG rolled out its non-QM platform, I pivoted some loans there. I think I did probably one of the first ones ever at the company. And I always saw that product as kind of like a great option to have in your toolkit, but it wasn't something that I really targeted. And as the market changed and as the business rates started going up, housing prices changed, people in this economy today, their types of income has changed. I mean, back in the day, everybody was typically W-2. There was some self-employed people, but majority of the income that you saw was somebody working for a company getting paid a salary. I've noticed gig workers are a big part of the business today. Contractors, people have different sources of income. So as the world has changed in the last couple of years, I knew that I had to evolve my business if I wanted to continue at a high level. I'm still doing lots of regular loans.
Mm-hmm.
And, as the market changed, a lot of my client base has evolved into people that have been declined at other places. And I made a name for myself with a lot of my referral partners. And um, in my opinion, you have to adapt with change. And if you're still sticking with things that are the same way you do business for 15 years, you're going to get left behind, especially with all these innovations like AI and things.
You know, FHA, VA, in our business, FHA, VA, non-QM are higher margin products, meaning that for the layperson who may be watching this doesn't understand, it just means that it will pay us more because those loans are harder to do. They're more cumbersome, if you will, than your average Fannie Mae, Freddie Mac borrower. So, first question I have for you, knowing that, was that a driving factor in your decision making process? Which, if it is, I applaud it. But I mean, what was the decision making? Why did you gravitate towards the non QM specifically versus FHA or VA, as an example?
Yeah, I mean, at the end of the day, I'm not going to turn down any options that come my way. And again, your regular mortgage stuff, agency, government, VA, FHA should always be your bread and butter, right?
Yeah.
But with the reason I pivoted to non-QM is I would get a lot of clients that just didn't fit the box, or maybe they did fit the traditional box, but they didn't get where they wanted to be. And with house prices increasing, maybe they wanted a bigger pre-approval. Maybe there was credit challenges. I started targeting those types of clients, and yeah, they definitely pay more. They're more profitable. They're difficult loans to put together as a result. But I didn't target them only because of the income. I targeted it as a way to build a name for myself in my neighborhood and show people I can do all types of loans, not just your cookie cutter 20% down 800 credit score client. And I think as an originator, you want to make a name for yourself, and especially if you can specialize in something that a lot of people can't do, that's going to be your in, because in today's world, you're competing with the internet, you're competing with AI, you're competing with chat GPT, and clients are more educated than ever. But at the same time, you're not going to find a lot of people out there that are going to know how to structure somebody who has 15 businesses. They get paid cash on the side. They have tax return challenges. Maybe they had an issue with their credit a couple of years ago. So it's just that you should evaluate all the different tools in your toolbox to scale your business.
I love that so much. I mean, look, I've been doing this for 36 years plus now. And I've always said the people that specialize are the ones who end up making the most money. And so I want to kind of drive, so as opposed to leading too much, I want to drive this point and have you share. How did you convince who are your referral partners, and how did you convince them to give you a shot in this particular area? I mean, you imagine if you're a loan officer for any company listening to you and they want to mirror your actions, which if we're lucky, you could tell somebody where the goose is that laid the golden egg. And if we're lucky, maybe 10% will actually follow through and go find that goose. So I have no worries about sharing details. And I don't think you do either, because we have an abundance mindset. And we also know that most people don't have the discipline that you have to become the expert that you've become. So my question is how did you go out and get people to refer business to you with respect to non-QM?
Absolutely. So one of my biggest sources of business these days, I would say, is a DSCR loan, debt service coverage ratio loan. And what that means is it's a type of loan program where, say you're a real estate investor and you want to buy an investment property. The traditional agency box, you got to qualify with tax returns. They're going to look at all your businesses. They're going to figure all those properties into the equation. Maybe they have a bunch of real estate properties and maybe they're taking losses on their tax returns, as most self-employed and real estate investors. So what I did is I started getting in front of a lot of real estate investors. I contacted every realtor that I ever did business with, especially during the COVID days. I really hit my old pipeline very hard. And I just made a name for myself. And I kept, when I would make cold calls and I'd call agents and go to conferences around town and different things, I would let people know I can do your regular stuff, but maybe you're a real estate investor who wants to scale their investment portfolio really fast. Or maybe you have a type of client that, maybe you're really big with the general contractor industry or certain industries that specialize in a lot of the non-QM products, like contractors, people that own their own businesses, different types of things like that. And I said, well, I don't need tax returns. I can still get you a house based on the cash flow of your business. Maybe you're a real estate fix and flipper and you buy houses and you renovate them. So I made a point to try to target all the niche things that I knew we could do and let people know I can do your 20% down or 3% down first time home buyer. But maybe you have a whole pool of people that in your mind, you thought could never qualify. And I would tell all my referral partners these different things, and they would go to their clients and say, listen, I know somebody that might be able to get you a home. And before you know it, I would do one, two, three, and I would start getting calls all the time. I mean, I took a call 20 minutes before this call. Somebody I did a loan for 5 years ago that does not qualify on taxes, and I did them on taxes, and I'm pivoting it to a non-QM loan today.
I
So
love that. Okay, so there's a great job, and when you said you were cold calling and calling on your referral partners, good for you, buddy. I mean that's what it takes, that grind, that grunt work, but it's paid massive dividends by doing that work in the beginning. You're now, as they say, kind of planting the seeds. You're you're now having an abundant harvest. Talk to me about why, because I've also watched you do this with clients. There's time is money, and sometimes just it's not just the ease of doing a non-QM loan over a traditional full doc loan, but sometimes you're competing. If you're trying to buy that particular home and you're worried that you're going to get outbid, or just the amount of time it's going to take you to be able to take action on that property, as opposed to me having to go and create a file that's this thick, I can come to you and get a file that's this thick, act quickly. Yes, I'm paying a little bit more, but talk to me about a scenario like that. When those borrowers come to you and you're able to convince them, look, pay the higher interest rate because it's going to pay you dividends with the property itself.
yeah, so lately in the last couple of years, I've really built up my luxury and jumbo market. Most of my jumbos these days are not like your traditional A plus jumbo. Non-QM jumbo pricing, I would say in the last 2 years, has really gotten closer to your regular pricing. So in the past, non-QM, you were like, oh, 8, 9, 10%. You think hard money, credit challenge people. Non-QM borrowers today have evolved into really high qualified borrowers, but just need a different way to qualify them. Think of it like smart old school underwriting, not, what does the AUS say? So one of the ways that I really grew that jumbo market for myself is when I take in a new client, or when I, to my old point of pitching, like calling referral partners and offering different things that we do, I would say, you could write a contract very aggressive. I'll close your $3 million loan in 2 weeks. Or when a client calls me and they ask, what's your rate, which I'm sure everybody has gotten, I'll say, well, what's more important to you? Do you want to close in 2 weeks, or would you rather save a half a point, but I'm going to need to know everything about you, including your firstborn child's social security number? And I'll give them both rate grids, and I'll say, look at the difference. For a half a point more in rate or 75 basis points, they'll be done in a week, and there's no chaos, and maybe we'll revisit a second mortgage or refinancing in the future. They call me and they say, yeah, let's do the faster option and we'll deal with it next year. And most people today think rates are going to change. So in their mind, it's like, maybe I'll just pay up to be done with it and deal with it in the future.
Well said. You said exactly what I was hoping you're going to share. I'm going to shift gears on you for a second because I want people to know who you are on a personal level. Is that okay if I get a little personal?
Definitely.
So, and this is important for people to hear because, while you are disciplined, you're hardworking, and you put in the hours, you're also a great husband and a great father. So tell me, you're married and you're a dad. Tell us about that.
Yeah, so I'm married. I have two boys, 4 and 2, and both of them are keep me crazy. The mortgage business alone is wild in itself, and then you come from going craziness in mortgages and being up all the time and doing your thing to going and dealing with my children at night and the whole routines with, as they're growing, T-ball on the weekends. It's been an awesome journey.
Your 4-year-old's playing T-ball already?
Yeah, my 4-year-old just started T-ball. So
congratulations. That's awesome.
I'll tell you, I would tell them what I told my father. My father told me. I probably want to put him in the mortgage business, but if they be into that, sales is the way to scale your income. So,
well, it'd be kind of fun for. Hopefully, I'm around long enough to see your son assist you and see the third generation of the Margolis family enter the business.
There you go. There you go.
So yeah, not to press too hard, but do you ever how do you handle? You've got a beautiful bride and great mom, but I mean, you're on camera a lot. You're taking care of your clients, and you're also helping all the other loan officers that here at PRMG structure their deals oftentimes late into the night, early in the morning. How do you convince your wife to give you that much time with us?
Yeah, she's not happy. But listen, the way I look at it, you only get so many opportunities in life, I feel like, to make a big killing and do really well in your career. I think right now the non-QM space is booming. Just like the COVID time, everybody grinded, worked tons of hours, and did as many as they can. I see non-QM as an opportunity to make as much money as you can and help as many people as you can get them in the homes. Not saying that these programs are going to go away, but you just never know. Most of non-QM is backed by insurance companies and hedge funds. And with companies like that, they just care about the bottom number. It's not like the government where they have quotas and things that they have to fulfill. So if the hedge funds and insurance companies just decide, it's too much risk with the way the world is, we're going to pull out, then that opportunity is gone. So as an originator, I would absolutely be considering these products in your toolbox and look at it as another opportunity. Like what I said, think of it as like a COVID 2.0. There are so many borrowers out here that are doing these types of products today. It used to be like the backup option. Today, this is the first choice for a lot of people.
Where should I go? What would be your advice for somebody who's a neophyte? They're a sharp person, but they're ignorant currently on how the non-QM process works. What would be your sage advice to get them to hit the ground running? What's some of the first things they should do?
Yeah, so the best way to do this at PRMG, and you don't have to know all the guidelines and you don't have to be an expert. The best way is email our team, and it's nonqm at prmg.net. And if you're a new originator who maybe isn't with our organization yet, you can just email me directly.
Well, now
There's
hold
going
on
to
there.
be,
Hold on. As your director, I don't know if I want to have unless you're going to recruit him to come work for the team. I want to make sure that we limit your exposure to the outside forces, right? Hell, your wife's going to send me a nasty email if you take on too much of that. But I do. I'm so glad you brought up the people who are not working for us because you never know where this podcast is going to go, right? There could be some loan officer working for a friendly competitor who sees you, and maybe they are happy where they are and they're going to stay where they are. So, regardless of where somebody works, what would you suggest somebody does in order to get up to speed as quickly as possible and collapse timeframes? What advice would you give that new person coming on to the industry, or they've been in the industry but they're just not aware of the non-QM space?
yeah. So the first question I would ask your clients is, what kind of issues are you having? Are they self-employed? Do they not show enough income on their tax returns? Are they credit challenged? Do they work multiple gigs? Maybe they do Uber and Lyft and different things like that. And then from there, if you can't put them in the traditional box, you should pivot that loan to our non-QM department and ask questions like, hey, I got this borrower who has a late last month on their credit and I can't go regular. And what should I do? The best way to scale this and learn it is asking questions. Don't just punt the loan because it doesn't fit the traditional agency box that you're accustomed to. Really the way it works is, once you do one or two, you're going to start picking up things that you need to look for, and then that'll be a way for you to learn it. You're not going to have to be expected on day one to be an expert at this stuff. I mean, listen, I'm still learning stuff all the time.
Well, that's something. Okay, that's interesting. So I want to make a statement, then come back with a question. So the statement is agree, and it's not clearly defined. I mean, you and I talk about this all the time. That sometimes, literally from day to day, week to week, quarter to quarter, different aggregators, different investors, different, we might, even us, we might have a different appetite for a product or a style of loan one week, and maybe it wanes the following. So some of it just comes down to case by case. But my question is that where can I go to learn? Because when you started, you didn't just know non-QM. Just like when I was first recognizing how successful you were doing at jumbos, you told me, Chris, I read the guidelines. Well, where I'm kind of drawing this out is I'm assuming you did the same thing with non-QM. You just started reading the guidelines to know the guidelines as well as your underwriter did. Is
That's
that
correct.
okay? So talk
Yeah.
about
So I
that.
mean, yeah. So the best way really is spend some time every day and just look at the products and look at the guides and look at what the minimum credit scores. In non-QM and in most normal, in most alternative, and even the regular stuff, there's updates all the time. A lot of times you're not even aware. So I'll constantly be reading different changes to the books, and looking at all the little carve outs. And then over time, if you spend a couple hours a week looking at that, you're going to be really skilled. I always tell everybody you can't sell what you don't know. So the more educated you can get on that product, the easier it's going to be to put that together and sell it to your client.
Why do you not, seemingly anyway, to me, why do you not get upset? See, there, I run, 600 loan officers across the U.S. And that's why I call this mortgage therapy. Sometimes I just need to kind of vent to people like you, and this helps me out. So I appreciate you being here. But some of these people get upset because they didn't, in my opinion, they didn't do their job by putting the file together. And maybe they told the client they could do something. They overpromised the realtor. Now they're under contract, and now they're finding out in the second or third week of a 4-week escrow that they've got a problem, and they'll start pointing the finger at everybody else, and that drives me batshit crazy. I don't think I've ever seen you do that. And is it just your personality style, or what advice would you give to that loan officer who's wound up and wants to get upset about the process? How can they mirror your actions and just get shit done and never seem to have people see you sweat?
I mean, I've had plenty of bang outs, so let's be clear with that. But in terms of deals going sideways, these days I try to prevent as much heartache as I can by asking the right questions and trying to figure out as much skeletons as I can. I rarely have deals fall out at the last second. I mean, if you look at my pull through, it's probably like 95%. And
Exactly.
it's not about me. So like advice that I could give somebody who's starting out in this space: ask as many questions as you can. And if you don't know the answer, don't throw it against the wall. Ask questions. And what I used to do when I started learning this stuff is, if I didn't know, or I thought something was weird, maybe the property looks a little funky, but it may be customary to where you live, but maybe it's just funky in the secondary world when they look at that. It has a barn and equestrian and horses. Maybe in your neighborhood, those are things that are normal, which is fine. But in the non-QM world, it's not. So I'll just try to ask as many things. I'll look at the population of an area. If I see something that doesn't look right, or a little out of the box, I'll ask. And over time, I started learning things that were gotchas. So I guess my piece of advice to that would be, try to figure out as much skeletons as you can, just like what you do on a regular loan, but you got to go a little deeper. I'll go into their bank statements and I'll look at deposits and things. If I see some funky deposits, I'm going to ask those questions. Don't wait for your underwriter to ask those questions. You should be doing your own homework up front. And then you'll get to the point where you slam that loan in, you close in 2 weeks, and you pick up 10 more deals because everybody else didn't know how to put that together. And that's how I built it up.
You work very closely. I'm going to shift gears on you again. You work very closely with our product development team and helping us to create our own underwriting guidelines. And so I'm going to basically just make a quick statement and then kind of throw it to you and have you kind of expand. So I know that here at PRMG, you've created guidelines with our team so we can actually underwrite, and we've got several investors that we can sell those loans to. That becomes an R issue, a PRMG issue, not the originator. The originator, we close a loan and they're fine, they're paid. We deal with the selling of that loan in the secondary. You also have 5, and I believe it's going to go up to, our CEO said, maybe get a max of maybe 7, what we call non-delegated relationships, meaning that we still make our max commission. We close the loan in our name, but it's a single execution with a particular investor. And then finally, we allow people to broker worst case scenario if there happens to be some obscure investor out there who has an appetite for a particular loan that maybe we didn't in-house, and this 6-7 relationships that we have for non-delegated, fine, if you want to make the least amount of money, you could broker that loan. Am I saying that properly? And is there anything you would to expand on?
Yeah, that's correct. So one of the best things about PRMG, especially working retail, is you have all these different options to bank a loan and close it and get paid on it. So to reiterate what you're saying, at PRMG, we have our own portfolio product for non-QM where we do everything in-house. It's our own guidelines. And when I say our own guidelines, we didn't create something like super unique that doesn't exist. We basically consolidated all the great things that I felt as an originator doing these and the rest of our team. And we built out our own program that has such a wide credit box that we felt that we could accommodate a lot of scenarios that most people see every day. In the past at PRMG, we had different programs that we would underwrite to the investors who are buying these loans. Today, it's just our own book. So we work with all the major non-agency buyers of these loans, so big hedge funds, big insurance companies. So, in our opinion, if one of those major outlets don't like the loan, PRMG gives you an opportunity to also go direct to those loan buyers, investors, and have them underwrite the loan, aka non-delegated. So, recap, we have our own portfolio product where we make the decisions, and we can also go to our capital investors to make decisions.
That's called delegated for the people that don't know.
That's called delegated, correct. Then we have non-delegated, where you go direct to the investor who underwrites the loan. They give us the conditions. You still close in PRMG's name, but you're allowing their underwriter, the one that's purchasing that loan, to give us the conditions. And then maybe it's just it's a type of loan or a situation where we're not comfortable doing it, or maybe that investor just doesn't offer it. We let you go broker, and we have a huge list of approved brokers, things like fix and flip, construction loans, maybe a farm that has 50 acres, things that just we're not going to be doing, but doesn't mean that another lender, doesn't or allows those things or doesn't allow those things. So we give you a huge waterfall to do loans with us. And a lot of times, maybe you're just a mortgage broker and you can say, yeah, I have the opportunity to go to different lenders as well. But working under a retail lender that does over $1 billion a month in business, we have a lot more weight than a lot of originators that go direct to those places. So I can tell you firsthand, we get exceptions, and even on my own deals and for other members of our company who I get loans approved that I can tell you right now that if you went on the street and you tried to put that together, you're not going to get that done without delivering the kind of loans that we do.
The volume, exactly. And the relationships, they do matter. So that was phenomenal. Great way to kind of speak, Chris, wind this down. On a personal note, I'm going to bring it back to you personally. What's your big, hairy, audacious goal for the next, we'll just keep this tight time frame, over the next 24 months, what are you hoping to achieve?
Personally or for the company?
Well, I want to ask you personally, what do you want to achieve? I think it's important for me to know that as well.
Yeah. I think my goal is to get back to 100 million a year in volume. So I think this year I'm probably trending to hit like 50, 60. So I think I can hit that in the next 2 years. In terms of my position as the non-QM business development manager, I think we're going to continue to evolve our products and get a lot wider and streamline the closing process, exceptions, pricing is continuously getting better. In non-QM, this is a great point that we should talk about. In non-QM, when you do a conventional loan, you price 3% down. Every lender on the street, you go to bank rate, every lender offers a 3% down. In non-QM, it is super difficult to compare apples to apples because that one loan can have 9 different variables that impact the pricing on that loan. For example, on non-QM, you can have a hit for just the DTI being over 45, or on Fannie Mae, that's usually not a thing. Or on non-QM, maybe that condo has issues and there's a hit for that. So when you're an originator and you're trying to compare apples to apples, it's very hard to price that apple fairly until you really get deep into underwriting. So what I would like to accomplish is we're trying to streamline our processing, our pricing aspect of it, trying to make underwriting as great as we can, and give an originator so many different opportunities to prevent, to your point earlier, the 11th hour, oh man, this deal's falling apart. So, and I think we're going to continue to grow. So,
mic drop. Well, I will commit to doing everything I can to help you grow your business. You're a good man, Charlie Brown. I really appreciate you as a man, as a father, as a husband. So you are consistent as the day is long, and I have nothing but the utmost respect for disciplined people, and you epitomize that. So it's nice to know you. It's nice to be your work partner and teammate here at PRMG. And for those that are watching, thank you for watching. Again, this is Chris Sorensen's Mortgage Therapy session, and Justin, thanks for being our guest. And until next time, keep going out there and serve for success. Thank you, everybody.
Thanks for having me. Thank you.
You bet.